Hello and welcome to Value Research Podcast. You're listening to First Page, a column written by Dhirendra Kumar. The art of elimination. Often, knowing what not to invest in is more valuable than knowing what to invest in. A persistent myth in investing is that success requires an almost mystical ability to predict the future. The conventional wisdom suggests that to be a successful investor, you must possess the foresight to identify the next Apple or Infosys years before their ascent. But what if this approach fundamentally misunderstands how markets work? I recently encountered some fascinating insights from Samir Arora, a veteran of India's mutual fund industry. His perspective challenges conventional wisdom and aligns perfectly with what I've long advocated in this column. Sometimes, the best investment strategy isn't about being brilliant, it's about being prudent. Here's the reality that most investment gurus won't tell you. In any given year, about 1/3 of stocks perform exceptionally well, another third perform poorly, and the rest fall somewhere in the middle. This pattern holds true across markets, including our own. The challenge isn't finding the winners. There are plenty of them. The real challenge is avoiding the losers. This brings us to what Arora calls elimination investing. The concept is elegantly simple. Instead of predicting which stocks will soar, focus first on eliminating stocks with red flags. It's generally easier to identify what might go wrong than to predict what will go spectacularly right. Think about it this way. When buying a home, you don't start by looking for perfect features. Instead, you first eliminate properties with deal breakers, poor location, structural issues, or price tags beyond your budget. The same principle applies to investing. But what about long-term investing? Here's another myth-busting insight. True long-term success often comes from a series of well-executed medium-term decisions. Instead of trying to predict where a company will be in 10 years, something even their management teams struggle with, focus on 2 to 3 year horizons. This time frame allows you to assess better industry trends, regulatory changes, and competitive dynamics. Consider this. Many of today's market leaders surprised everyone, their management, investors, even themselves, with their growth trajectory. They didn't become giants because someone accurately predicted their rise a decade ago. They succeeded because they continuously executed well over multiple 2 to 3 year periods. For the practical investor, this approach offers several advantages. First, it's more forgiving. You don't need to be right about everything. You just need to be good at spotting obvious risks. If a company has poor management but attractive valuations, eliminate it. If it's well run but grossly overvalued, eliminate it. Be liberal in your rejections. Remember, plenty of good investments remain. Second, it's more realistic. Analyzing a company's prospects over 2 to 3 years is far more manageable than trying to predict its position a decade from now. You can reasonably assess industry trends, the regulatory environment, the competitive advantages within this time frame. Finally, it's more adaptable. By regularly reviewing your positions every few years, you can adjust to changing circumstances. If a company continues to execute well, you can maintain your position. If new risks emerge, you can eliminate them from your portfolio. This doesn't mean you should trade frequently or abandon the principles of patient investing. Rather, successful long-term investing is a series of well-executed medium-term decisions, each made carefully considering what could go wrong. This approach offers a practical path forward for the average investor. Instead of chasing the next big thing or trying to predict the distant future, focus on eliminating obvious risks and maintaining a reasonable time horizon. It's not as exciting as hunting for the next multi-bagger, but in investing, boring is often beautiful. Remember, wealth creation isn't about making brilliant predictions. It's about consistently making sensible decisions while avoiding major mistakes. Sometimes, the best investment strategy isn't about finding what to buy, but knowing what to avoid.